All right, let's dive into employee compensation. And I know that might not sound super exciting, but trust me, this stuff is crucial for the CFA Level 2 exam.
Yeah, we're talking about those long-term compensation plans that involve payments way out in the future
Yeah.
and lots of assumptions, which can make things pretty tricky.
Tricky, definitely, but I guess that's why it's a Level 2 topic, right? So before we jump into the nitty-gritty, can we just take a step back and clarify the different types of employee compensation?
Absolutely. You've got your short-term benefits like salaries and bonuses. Those are pretty straightforward.
Yeah, we all know about those. Pay slip every month, done.
Right. But what we're really focusing on here are the long-term plans, and those tend to be a bit more complex because they involve future payments and costs that are uncertain.
Makes sense. We need our crystal balls for this one.
Well, maybe not crystal balls, but definitely some solid financial modeling skills.
Okay, I'm all ears. So what are these mysterious long-term compensation plans?
The two main categories are share-based compensation and post-employment benefits like pensions.
Ah, stock options and pensions. I'm starting to see why this is a big deal for us CFA candidates. So let's start with share-based compensation. Why are companies so keen on offering things like stock options to their employees?
Well, for one, it can be a powerful way to align the interests of employees and shareholders.
So if the company does well, everyone wins.
Exactly. It's like they're all on the same team working towards the same goal.
That makes sense. And it can also be a great way to attract and retain top talent, especially in those competitive industries like tech, right?
Absolutely. Offering a piece of the company can be a pretty sweet deal, especially for employees who believe in the company's long-term potential.
But it's not just about attracting talent. There's a financial benefit for the company too, right?
Absolutely. Share-based compensation, like stock options, can help companies conserve cash.
So instead of paying out big salaries, they can offer equity.
Exactly, which can be especially helpful for startups and rapidly growing businesses that need to preserve their cash.
Okay, it's starting to sound like a win-win for both employees and the company.
It can be, but like with most things in finance, there are some downsides to consider as well.
Uh-oh. Here comes the reality check. Tell me more.
Well, for starters, employees often have very little control over the share price. They could be working hard, exceeding expectations, but if the market takes a downturn or the company makes a strategic misstep, their compensation takes a hit.
Ouch, yeah. Imagine putting in all that effort and seeing those stock options lose value. Must be disheartening.
It definitely can be a risk for employees. And then there's the issue of excessive risk-taking.
Now that sounds interesting. Tell me more about that.
Well, with options, you're essentially rewarding upside potential. So managers might be tempted to gamble on riskier ventures to try to boost the share price in the short term.
I guess those options can sometimes create a go big or go home mentality.
Right, even if those risky moves aren't necessarily in the best long-term interest of the company.
Okay, so there are definitely some trade-offs to consider. But now let's get into the accounting for all of this, because I have a feeling it's not as simple as recording a salary expense.
You're absolutely right. Share-based compensation is treated differently from a financial reporting perspective. We're not just hitting a liability on the balance sheet, we're impacting equity.
Okay, so I'm debiting compensation expense, but I'm crediting what exactly?
A share-based compensation reserve account. And we need to remember that vesting period we talked about.
Right, because employees don't typically get all the shares or options up front. They have to earn them over time.
Exactly. That means the expense is recognized over that vesting period, not all at once.
Okay, I'm starting to get the picture. But I think a real-world example would help solidify this.
Yeah.
What's a company that's been in the news lately for its use of share-based compensation?
How about Meta? They've been relying heavily on share-based compensation, particularly with those soaring stock prices we saw back in 2020 and 2021.
Yeah, their stock was on fire for a while there. But it's come back down to earth a bit more recently.
Exactly, and those wild swings in share price have had a pretty significant impact on their financial reporting.
In what way?
Well, for one, it's impacted their tax bill. Back when their stock price was surging, they were able to deduct a larger amount for share-based compensation on their tax returns, which lowered their effective tax rate.
So they were paying less in taxes because their stock was doing well.
Right. It's a quirk in the tax code that allows companies to deduct the actual value of the shares or options when they're exercised or vested, even though they might have recorded a lower expense on their income statement based on the fair value at the grant date.
Interesting. It sounds like share-based compensation can create some pretty big discrepancies between a company's accounting income and its taxable income.
Absolutely. And those discrepancies can be volatile if the share price is bouncing all over the place. Just look at what happened to Meta in 2022. Their stock price tanked, wiping out those tax benefits they had enjoyed in the previous years.
Ouch, yeah. That's a harsh reminder that what goes up can also come down. Anything else we need to keep in mind about share-based compensation?
We also need to consider how it impacts share count. When companies issue new shares to employees, it dilutes the ownership of the existing shareholders.
Diluted EPS. Right, that rings a bell. It's all about how those potential new shares from options and restricted stock units could impact earnings per share.
Exactly. And analysts need to adjust for that potential dilution when they're valuing a company.
So we use something called the treasury stock method, right? That helps us calculate a hypothetical share count that takes into account all those potential new shares.
Right. It's based on the assumption that the company will use the proceeds from exercising those options to buy back shares, which would offset some of the dilution. But even with that offset, share-based compensation can have a meaningful impact on a company's valuation.
Got it. So we've talked about the motivations, the risks, the accounting, and the impact on share count. Anything else we need to cover before we move on to post-employment benefits?
Just one more thing, how to actually incorporate all of this into our financial models and valuations. It's one thing to understand the concepts, but it's another to actually apply them in practice.
You're reading my mind. I was just about to ask about that.
All right, let's dive into the world of forecasting and valuation. Okay, so are you ready to tackle the other big beast in the world of employee compensation?
You mean pensions and all that? Bring it on. I think I've got my head wrapped around share-based compensation, but pensions always seem like a whole other level of complexity, especially when it comes to the CFA exams.
Yeah, you're not wrong. Pensions can be a bit of a headache, but they're a crucial part of understanding a company's financial health. So we got to dive in.
All right, lead the way. Where do we even begin?
Let's start by understanding the two main types of post-employment benefit plans you'll encounter: defined contribution plans, or DC plans, and defined benefit plans, or DB plans.
Okay, DC versus DB. I'm already getting flashbacks to those acronyms from the curriculum. What's the key difference for us as analysts? Which one should we be more worried about?
Well, both are important, but DB plans tend to be more complex from an accounting and valuation perspective. With a DC plan, it's pretty straightforward. The employer makes their contributions, often matching some portion of what the employee contributes, and that's pretty much the end of their obligation.
So it's like giving the employee a retirement savings account and saying, here you go, invest wisely.
Exactly. The employee bears the investment risk. If those investments do well, great. If they tank, well, that's on them.
Seems pretty simple. Why wouldn't all companies just go with DC plans?
Well, from the employer's perspective, DC plans are definitely less risky, but employees might prefer the security of a defined benefit plan.
Ah, right. Those DB plans are more like traditional pensions, where the employer promises a specific payout upon retirement, usually based on a formula that takes into account years of service and salary.
Exactly. And that's where things get a bit trickier, because now the employer is on the hook for ensuring those benefits are paid out regardless of how the investments perform.
So they're taking on both investment risk and what you called actuarial risk earlier.
Yeah, you got it. Actuarial risk is all about those assumptions: how long employees will live, how much their salaries will grow, how many will stay with the company long enough to vest in those benefits.
Right, and if those assumptions are off, it can have a big impact on the company's bottom line.
Huge impact. It can make those future pension obligations balloon, even if the plan's investments are doing okay.
Okay, I'm starting to see why companies might be shifting towards those simpler DC plans. They're trying to minimize risk and hand off some of that responsibility to the employees.
Exactly. But there are still plenty of companies out there with large DB plans, especially those more established companies, so we definitely need to understand how to analyze and value those.
All right, let's get down to business then. How do we account for all of this?
Well, first, we need to understand something called funded status, which is a measure of how well the plan's assets are covering its future obligations.
Funded status. Okay, it's ringing a bell. Remind me how we calculate that.
It's basically the fair value of the plan's assets, which are all those investments the plan holds, minus the present value of the pension obligation.
Present value. There it is again. Those future pension payments can be decades away, so we need to discount them back to today's dollars.
Exactly. And that discount rate is incredibly important. A small change in the discount rate can have a huge impact on the present value of those future obligations.
So if interest rates fall, the discount rate goes down, and the present value of the pension obligation goes up, even if nothing else changes.
Precisely. And this is a big deal for companies with large DB plans. They're much more sensitive to interest rate movements than companies with DC plans.
Okay, I'm starting to see why investors get a bit nervous when they see companies with large underfunded pension plans.
They're like ticking time bombs. And we've seen some high-profile cases where those bombs have exploded, like General Electric, for example.
Oh yeah, GE and their infamous pension troubles. That was a wild ride.
Back in 2007, their pension plans actually had a surplus. They had more assets than they needed to cover their obligations. Fast forward a decade, and that surplus had turned into a massive deficit.
How did that happen? Did they just completely mismanage the funds?
Well, there were a lot of factors at play, but a big one was those historically low interest rates we saw after the 2008 financial crisis.
Right, those low rates pushed up the present value of their pension obligations, even if their investments weren't doing too badly.
Exactly, and it highlights a crucial point. Companies with those big DB plans can get really hammered by interest rate movements.
Okay, I'm definitely taking notes on that one. So we've talked about funded status, those scary interest rate effects. What about the income statement? How do we account for the cost of those DB plans?
That's where it gets even more interesting. With DB plans, there are multiple components to the pension expense, and the treatment can vary slightly between IFRS and US GAAP.
IFRS versus US GAAP, one of our favorite recurring themes as CFA candidates. All right, hit me with the IFRS version first.
Okay, so under IFRS, you've got three main components to the pension expense: service cost, net interest expense or income, and remeasurements.
Service cost, net interest. Sounds familiar. Remind me what those are all about.
Service cost is basically the increase in the pension obligation that's due to employees working another year. As their years of service increase, their future benefits increase, and we need to recognize that cost.
So even though no cash is changing hands today, we're recognizing the cost of those future benefits as they're earned.
Exactly. Net interest expense or income is a bit more nuanced. It basically reflects the financing cost of the plan.
Financing costs, you mean like the interest expense on a loan?
Kind of. If the plan is underfunded, it's like the company has borrowed money to cover those future obligations. So they have to recognize an interest expense on that liability.
Okay, that makes sense. But what if the plan is overfunded?
Then it's like they've invested those extra assets and they're earning interest income. So they'd actually recognize net interest income on their income statement, which would reduce their pension expense.
Interesting. So the interest part can go both ways depending on whether the plan has a surplus or a deficit.
Exactly. Now let's talk about remeasurements. This is where things can get a little tricky.
Uh-oh, remeasurements. I'm already bracing myself. What exactly are we remeasuring here?
Remeasurements capture those changes in the pension obligation that are outside of the normal service cost and interest accrual.
Changes like what?
Well, remember those actuarial assumptions. Those assumptions are constantly being revisited and updated as new information becomes available. And those changes can impact the pension obligation, leading to actuarial gains or losses.
Right, like if people are living longer than expected, that's an actuarial loss, right?
Exactly. Or if salary growth is higher than anticipated, that can also lead to an actuarial loss.
Okay, those make sense. What else are we remeasuring?
The other big one is the difference between the actual return on plan assets and what we expected that return to be.
So if those investments are killing it and exceeding expectations, that's a gain. And if they're tanking, that's a loss.
You got it. And those gains and losses can swing the pension obligation up or down.
Okay, I think I'm starting to get this. So remeasurements are essentially capturing all those unexpected changes in assumptions and investment returns that can really throw off our pension calculations.
You nailed it. Now, here's a key difference between IFRS and US GAAP.
Hit me with it. I'm ready for an accounting standards showdown.
Under IFRS, remeasurements are recognized in other comprehensive income, or OCI.
OCI, that separate section below net income on the income statement.
That's the one. So under IFRS, those remeasurements don't directly hit net income in the current period. They're kind of like a holding pen for gains and losses that eventually get recycled into net income.
Interesting. It's like smoothing out some of the volatility from those pension plan adjustments. What does US GAAP do differently?
US GAAP is a bit more flexible. Companies can choose to recognize remeasurements immediately in net income or put them in OCI and amortize them over time.
So it's like they have some options, some choices about how to present those gains and losses.
Right, and that can make comparing companies a bit tricky, but that's why it's so important for us as analysts to dig into the footnotes and understand how those pension plans are being treated.
Okay, I'm definitely making a note of that. Now, can we see how this all plays out in an actual example? I'm a visual learner, so seeing the numbers would be super helpful.
Absolutely. Let's revisit our friends at Workflow Corp. Imagine they decided to be super generous and implement a DB plan for their employees.
Workflow Corp, the gift that keeps on giving for our deep dives.
Okay.
Okay, so they're setting up this new pension plan. What happens next?
Well, let's say they make a big initial contribution to the plan. Under IFRS, that contribution would show up as a net pension asset on their balance sheet.
Makes sense. It's like they're pre-funding those future obligations.
Exactly. And then throughout the year, they'll recognize various pension-related expenses on their income statement, like service cost and net interest. The remeasurements will get tucked away in OCI for now.
Got it. So it's like this ongoing process of recognizing costs, adjusting for changes in assumptions, and tracking the funded status of the plan.
You got it. And those actuarial assumptions can really make or break a company. Imagine if Workflow Core assumed their employees would retire at 65, but then a bunch of them decide to work until they're 70.
That would mess up their calculations big time.
Absolutely. They'd have to recognize those extra years of service costs, and their pension liability would increase.
Okay, I'm officially convinced that pensions are a force to be reckoned with. We can't just gloss over them when we're analyzing a company. They can have a huge impact on cash flows, profitability, and ultimately valuation.
Couldn't have said it better myself. And speaking of valuation, that's exactly what we'll cover in the final part of our deep dive. Get ready to bring all of this together and see how those pension plans factor into our DCF models and multiples-based valuations.
Okay, I'm ready to tackle the valuation piece of this whole employee compensation puzzle. We've covered a lot of ground so far, but how do we actually incorporate all this stuff into our financial models and valuations? I mean, does it really make that big of a difference?
It can make a huge difference, especially when you're dealing with those defined benefit pension plans, the DB ones. Those can be a real wild card in a valuation.
Okay, so let's start with those DB plans, the more complex ones. How do we deal with those in our models? Do we need to create like a mini model just for the pension plan?
It depends. If it's a small plan, well-funded, and maybe even closed to new members, you might not need to get too granular with it. The impact on the financials might not be material enough to warrant the extra effort.
For a judgment call, right. We need to focus on what really matters.
Exactly. But if those DB plans are large and underfunded, which, let's be honest, is often the case, then yeah, we need to roll up our sleeves and build a more detailed model to really understand what's going on.
A model within a model. Sounds like fun. What's the basic approach here?
The key is to forecast each component of the pension expense separately. So that means projecting things like service costs, net interest expense or income, those remeasurements we talked about, and how much the company is contributing to the plan each year.
Okay, so we're breaking down that big, scary pension expense into smaller, more manageable pieces. And by forecasting those components individually, we can get a better sense of how those pension plans might impact the company's financials over time.
Precisely. We're trying to get a handle on future cash flows, right? That's what valuation is all about.
Right, future cash flows. So how do we factor all of that into our valuation? Should we be thinking about pension obligations like debt on a company's balance sheet?
That's a great way to think about it, especially if the plan is underfunded. Remember funded status? Well, if a company has a net pension liability, meaning they don't have enough assets to cover those future pension payments, then yeah, you absolutely need to treat that liability like debt when you're valuing the company.
Makes sense. So if we're doing a discounted cash flow or DCF valuation, we'd want to adjust the company's debt level to include that net pension liability, right?
Exactly. We're trying to get a clear picture of their total obligations. And for multiples-based valuations, you might adjust the denominator of the multiple to account for those underfunded pensions as well.
Got it. So an underfunded pension can drag down a company's valuation. What about overfunded plans? Do those boost the valuation?
That's where things get a bit tricky. You might think, hey, more assets are always better, right? But it's not that simple. Those excess assets in a pension plan are often restricted. The company can't just tap into those funds for other purposes.
So even if they technically have more assets than they need to cover the pension obligations, they can't really access those funds? So does that mean we just ignore overfunded plans in our valuations?
Pretty much. They're kind of a neutral factor in most cases. It's really those underfunded plans that we need to be paying close attention to.
Got it. Anything else we should be thinking about when it comes to pensions and valuation? There's been so much to absorb already.
One more thing. Don't forget about those future service costs. Remember how we talked about those representing the increase in the pension obligation as employees work another year?
Yep. And under IFRS, we expense those on the income statement, even though no cash is going out the door today.
Right. But here's the key. When we're doing a valuation, especially a DCF, we actually need to subtract those future service costs from free cash flow.
Well, not subtract them. But they're non-cash expenses. Why would we do that?
I know, it seems counterintuitive, but We have to remember that those future service costs represent future cash payments that the company will eventually have to make to their retirees.
So even though it's not impacting cash flow today, it's a real cash outflow that's looming out there in the future.
Exactly. And by subtracting those future service costs from our free cash flow, we're ensuring that our valuation is capturing the true cash-generating ability of the business over the long haul.
Okay, that makes sense. We're not just looking at the here and now. We're thinking about the long-term cash flow implications.
Precisely. Whether it's share-based compensation, pensions, or really any kind of long-term liability, we need to understand how it impacts the company's future cash flows and adjust our valuation accordingly.
This has been a seriously deep dive, but I feel like I have a much better grasp on these concepts now. I'm not going to lie, pensions used to intimidate me, but now I feel much more confident.
That's great to hear. And honestly, this stuff is challenging, even for seasoned professionals. The key is to keep practicing, understand those nuances between IFRS and US GAAP, and always think critically about how these compensation plans are impacting a company's financial position and valuation.
Couldn't agree more. It's all about piecing together the puzzle, right?
Yeah.
Figuring out what assumptions are reasonable, what risks we need to be aware of, and how to incorporate all of that into our analysis.
Exactly. It's a process, and it takes time and effort to master these concepts. But it's absolutely essential if you want to be a successful financial analyst.
Well, I'm feeling much more equipped to tackle those CFA exam questions now, thanks to your guidance. I'm sure our listeners are feeling more confident too, so until next time, happy studying, everyone.